Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Claudia. It's fantastic to have you on the podcast show. I've been looking forward to this for a while now.
Yeah, I'm so happy to be here.
Great. Now, before we go into the heart of our conversation, I do like to ask all of my guests something about their origin stories. So in your case, what did you study at college? And was it inevitable you'd end up in economics as a profession? And what are some of the sort of key career milestones that you've had?
So I, as an undergraduate, went to Denison University, which is a small liberal arts college in Ohio. I grew up in Indiana, so very, very Midwestern. When I went to Denison, I had no idea what an economist was. Basically, I did take an economics class my first semester, and I really fell in love with it and the idea that economists can do good in the world. So I've always been very oriented towards economic policy, and yet I really embraced the liberal arts. I did a triple major in economics, political science, and German. I did a study abroad in Germany. I spent a year in Germany on a Fulbright after my undergrad.
What's the interest in Germany, by the way? Why German and Germany? That's quite random.
I had taken German in high school. It was just a really excellent teacher who taught German and English. And I don't know, that just really caught me. And we did a student exchange, so I had from one family, the brother and sister had stayed with us, and I went, my brother went. So it just I made a connection. There was, again, no reason, just like there was no reason for me to go off and become an economist, given my background. And so I continued with that at Denison, and I did a study abroad for one semester in Berlin, which was awesome. Berlin is probably still one of my favorite cities. And then after undergrad, I went to Dresden for a year. And it so happens my sophomore year, when I came back, this was my junior year, when I came back from the study abroad, I met future husband who is German. So now he's kid's dad. So in any case, it was a good, spend a year in his hometown. And, but again, I was really economics was the direction I was headed in. And it's not that I didn't question that at certain points along the way, being exposed to some of the more theoretical parts of economics. I worked for 2 years as a research assistant at the Brookings Institution. That reminded me, yes, economists do policy. And I went off and did a Ph.D. at University of Michigan, which has their macroeconomics program is a fairly applied one. So there is a big policy interest. My advisor was really adamant that I was the perfect board economist, given my training and my interest in policy. And so I spent a decade at the Federal Reserve, a little more. And I will say, you talk about formative moments. I arrived at the Federal Reserve in the summer of 2007 as one of the leads on consumer spending. I watched, as a total newbie trying to do the forecast, I watched the financial markets melt down. I watched the Great Recession hit the US economy, and I was a forecaster for years after that. So I saw how damaging that was. And I did a lot of research on support to families, whether it was stimulus checks or tax credits, payroll tax cuts after the Great Recession. And in some ways, it really radicalized me that we need better fiscal policy in recessions. And eventually, that's why I left the Fed in 2019 to work on fiscal in recessions. And not even 6 months after I left, the pandemic came. So basically, the lesson is I should never switch jobs, because every time I start a job, the world falls apart. But I got
so
to do.
So you have to tell me when you next switch jobs.
Yeah. Yes, yeah. When I leave consulting, something bad will happen. No, but so I learned. I left the Fed to work on fiscal policy. I absolutely have. This has been a completely miserable 4 years. For people in general, the pandemic was horrible. And as a macroeconomist trying to make sense of the world, this has been a tough go. And we're not out of it yet. So it's, but I've been very privileged to have the opportunities that I've had. And there's been a lot of learning experiences along the way.
It's a fantastic kind of overview there. It sounds like you're very, very much sort of applied in the real world, as you say. So maybe we can start with the COVID period onwards, the sort of pandemic era, and maybe we can start with fiscal, perhaps. So one of the criticisms around policy after the great financial crisis was that there wasn't enough fiscal. We went down to austerity, and that prolonged the slowdown and the recession thereafter. What what would you say about the fiscal policy that the US instituted after COVID?
The US they went big, they went fast, and they went broad, right? And that was the CARES Act was what we absolutely needed. Like, and I don't think there's a lot of questions about that. Any of the programs we could run better, like the payroll protection program, excellent idea. Keep workers on the job, support the employers so they can do that. It hadn't been done before, and frankly, the administrative tools for it were not up to the task. So in the end, it costs a lot of money per worker. That doesn't mean the program was a bad idea. It just means we have got to be ready to do it better next time. And the same thing with unemployment insurance benefits. Like anytime we put policy together in the middle of a crisis, it will not be perfect, right? And so a big lesson learned from this must be go back and be ready, right? Like that's the kind of work I'd been doing even before COVID. So there, and what was amazing, I mean, it was $2 trillion. It came together very quickly. It went to businesses, unemployed families, I mean, you name it, people were getting money and support, which is what we needed in the spring of 2020 when I mean, that was bad. That was really bad and it was scary. The and there were countries around the world that made a similar big push with fiscal, right? It wasn't just the United States. The United States distinguished itself in when we got to the rescue plan. So this was the beginning of the Biden administration. We went big again. That was another $2 trillion package. It again had broad support, or like went broadly out to different groups. And I mean, again, it was big, right? At this point, the recovery was starting to gain steam, but we still had 6% unemployment when that was passed, right? In normal times, that would have been a get the money out kind of moment. But I mean, COVID was very different. The United States is the only country of our peer countries that had a rescue plan. Like by that point, other countries were not doing more big fiscal. Like they'd done it in the beginning. So the United States within a year put out more than $5 trillion in relief. That's a lot of money,
Yeah.
right? Even
I
for the
mean,
United
do I sort
States.
of sense you're saying that maybe the second one, the rescue packages, were not necessary?
I was at the time and remain a big proponent of the rescue plan. To me,
Okay.
that was what was missing after the Great Recession. I mean, frankly, the first plan, the first Obama relief package was much smaller. It was like $1 trillion instead of CARES was 2 trillion. And yet, as you went on, and you mentioned this, as we went in on the recovery from the Great Recession, not only did fiscal not show up more, as it was really clear that was a real slog, Congress actually went backwards into austerity, right? And so this piece of the rescue plan, which was on into the recovery, and yet we weren't out of the woods to say we're going to go back in one more time. This was clear we weren't out of COVID. I mean, the rescue plan was to get us to the other side and to really kickstart the recovery. It did. It did cause some inflation too. It was big, and as someone who worked on the stimulus checks through all of these packages, I would never have put the biggest stimulus check last, right? Like this didn't, people would ask me, oh, where did, then President Trump come up with $2,000 checks? I'm like, I don't know. Like, this is not what I would have suggested as a dollar amount, maybe to begin with. So that's why I work a lot on automatic stabilizers. These kind of policies, the direction should be set up ahead of time. I mean, frankly, they should be put on autopilot and taken out of politics. But even if you don't have some guidelines about if we see this in the economy, we should do X and like have anyway. So yeah, the rescue plan could have been better, but we needed to have it. Right. And
Yeah.
so, and it needed to still, I am a firm believer in if you have the choice between swinging for the fences and maybe, swinging too hard versus not doing enough and being really weak on, you pick the swing for the fences. Like people are worth that. And in fact, we've had, yes, inflation went up, but inflation went up around the world. And again, we went bigger on the United States went bigger on fiscal. So you can't point that all at, the rescue plan because we were going to have high inflation regardless. In the United States, we had a labor market that was really working quickly. It was working for the low wage workers. we put a lot of money in people's pockets. They spent, but they also saved, paid down a lot of debt. And that has given us a buffer from the higher interest rates. And I mean, if you look and other, we're not out of the woods with all the pandemic disruptions. And if you look at the United States now relative to our peer countries, our recovery is better.
Hmm.
Like it's notably better. And what we're starting to see in Europe, there was news recently about France's, their growth projections have come in lower, right? So their economy is not growing as quickly, and it's certainly not growing as quickly as the US. That means their tax revenues aren't what they projected. So they're going to have to cut back on spending. And it's like it's just like the Great Recession all over again. Like the worst time to do austerity is when your economy is in a weak place. But I
Yeah.
mean, there is a logic to it. Like they're trying to hit a certain fiscal rule where their deficits aren't too big and their taxes aren't enough, and they won't raise taxes. So it's complicated. But the U.S. like that's not what's happening here. Like
Hmm.
we're
Now,
back
on the,
on
on the
trend.
inflation point, I mean, many people did attribute part of the inflation spike to US fiscal. And
Mhm.
while other countries didn't do sort of the second wave of fiscal, the US, being the largest economy in the world, will kind of, you know, is kind of a leading,
Mhm.
driver of everything. So, in terms of inflation since COVID, I mean,
Mhm.
how do you think of the evolution of COVID since then in terms of the factors that drove it
Right.
all? Because that also kind of goes to the heart of what the right policy response should be and what it should be now.
Right. So I think there was an intellectual case to be made in either direction that this was largely COVID and temporary inflation, or it was demand driven inflation and could become embedded, right? And thus you
Yeah.
might need a recession, right? So these two stories, very different, but they're plausible, right? So we got to 2023 and we saw a period of big disinflation. So inflation came down in the United States and growth stayed strong and unemployment stayed low. So then that's telling you that at least, I mean, there's still a lot of debate over this, but to me, it really lines up with a story of these were COVID disruptions, largely, not entirely. Like I kind of think of it like 2/3 was COVID and maybe a third was big fiscal, right? So I don't want to say this is all of it, but that you needed to work those through those disruptions. And I think of the disruptions not just as supply chains. That was clearly there, and we've seen it come off the goods prices. We also, at the beginning of the pandemic, saw millions of workers walk away from work, like leave the labor force. Maybe they had caregiving responsibilities, maybe they didn't want to die because they were older workers. And we've slowly, and last year in 2023 was when we really made big gains on the labor force, which took pressure off this labor shortages and wages that, costs that were being passed through to consumers. So that's another COVID disruption. And one that's on the demand side that's different from fiscal is when we shut the economy down or we just told people it's not safe, right, to go out and do services, we had a lot of people just not spend as much. So there was a lot of pent up demand. And there are estimates that the pent up demand by the top 20% of households by income, so people who are not getting stimulus checks or rescue plan, that like that was as much as what's the quote unquote excess savings, right, of the bottom 80%, whether that was stimulus checks or unemployment benefits. And so in 2021, when the vaccines went out, we're like, it's safe now. You had a lot of pent up demand, including, and there was also a lot of fiscal come out kind of at the same time. And so, but if that was, you can only, once pent up demand is no longer pent up, then it
Hmm.
passes. Right. And so that was, and the stories would be about the revenge travel, right? Where people had been, so they're, and it's like you can only do so much revenge travel. And then you just get back into your usual pace. So, I mean, COVID hit the economy in some very complicated ways. And it has taken much longer to unwind those disruptions than we thought. And yet, in my expert opinion, if you look at 2023 and how the pieces came together, and we didn't have a recession and growth stayed strong, then it tells you something about that inflation that there was a lot of COVID in there.
Yeah.
Because
I mean, do you think? in some ways you could say that COVID, did also have this sectoral shock. Goods got hit. Goods benefited to start with in terms of everyone staying home and buying Amazon stuff, and then services got hit, and then you had the supply chain which hurt the goods sector. So maybe last year could also be characterized as one where the goods sector healed itself, and there was excess inventory, and goods prices fell, and oil prices didn't go up as much. But services inflation has stayed strong, which is reflective of the strong economy. And so, we've had this kind of desynchronized goods and services cycles. And so this year you could have in 2024, you could have a situation where you don't have as much goods disinflation because that's all worked its way through. And because the economy is strong, services inflation stays high. And so you end up seeing inflation will end up being higher than people anticipate this year. I mean, do you think that's a possible, is that a fair base case or not?
So it's not my base case, but it is a legitimate risk. Yeah. Like in my mind, and there are certainly people who have that as a base case. That is a story that, like I was recently listening to Fed Governor Chris Waller had sketched out something very similar to this. So my argument on the services inflation, there's a couple of pieces to it. When we have a development in the economy, the last place it shows up is in consumer inflation, right? Like there's a whole pipeline that gets to the consumers. And as I was saying, it really wasn't until last year that we saw this big increase in the labor force participation, that we really started to see getting past those extra labor costs. So it takes time for that to feed through. So, that's a recent-ish development. So there's no, if you think of like one of the important costs that go into services are the labor costs, right? And so, like I said, we've seen an increase in the labor force. We have seen no evidence of a wage price spiral. And like there are different measures of wages out there, but the employment cost index, which is considered that's one that the Fed looks at, it has clearly decelerated. And at the same time, we have productivity growth that appears to be higher. So those wage pressures on firms do not appear to be what they've been in the past. And you also have the Atlanta Fed has a really great survey on asking businesses their expectations for like their costs over the coming year. And those have really moved down markedly. So you see in the pipeline what should show up in services cooling off. Now, we've been looking for a very long time for the shelter prices, for the rents to come through. That was not a good surprise for January on the housing, the owner's equivalent rent. There are some pieces in services like auto insurance that don't just have to do with labor costs, right? Like this is, vehicles have gotten more expensive. They have to do the repair. And there's just a lot of things going on under the hood. I don't want to get into cherry picking, like this series is better, that series is better. But again, I think the labor developments will feed their way through. And then to the good story, goods have been, like those prices in a quality adjusted way have fallen over time, right? And this part of this is globalization, part of it's technology. And there's no reason to think you're going to go to these being a notable drag to a positive, right? So I agree that the drag on inflation will probably be smaller. And yet we have other pieces in train that can bring it down. But it's absolutely something to watch with the services. And, not every month is going to be a good month in terms of the news on it. And yet we've had several months of disinflation that one should be wary to discount and yet keep an eye on. We don't want to get stuck. And also, we're not that far from the target. Core PC price inflation, it's within a percentage point of the target. So that's not good enough. We got enough, but like this is not still a 5-alarm fire.
Yeah.
Like that was the middle of 2022. We've gotten to a better place.
I just wanted to pick up on one or two points you just said. One is in terms of the wage costs and the unit labor costs, with productivity sort of being quite benign. how do you sort of link that then to sort of the level of profits we've seen, since the pandemic, which have been incredibly high, and many people have been looking for profits to fall, and that as a, and this kind of realignment between, capital and labor, after decades of like wage suppression. How do you kind of think about those two things?
Right. So we're going to be debating what's gone on with profits for a very long time. Right. And I'm not punting on an answer. I have something to say here. I am very sympathetic to the view that Isabella Weber and others have put forward, that we had some extraordinary circumstances that COVID and then Putin created. Right. And some of it, there were cost pressures on firms, there were supply disruptions. Um, People understood that. Like, there was a reason for the higher prices, but it's also an opportunity for businesses to push a little harder. Right. So, as an example, and these prices have come down, when there was the bird flu and egg prices shot up. And I mean, everything, eggs, eggs, eggs. There were companies that sold their eggs at these high prices, even though all of their birds were fine. Right. So it wasn't an opportunity to say, oh, I'm going to undercut the competition and try to pick up market share. It's like, oh, now I have an opportunity to push prices up. So that makes perfect sense. I mean, there's a branding of this as greedflation, which I'm not terribly fond of that term as a, like, I mean, I can get the marketing maybe is nice, because we're all greedy all the time. But if something happens that allows them to push up their margins, well, they're going to do it. Right. So there is a story that there were extraordinary circumstances. And in economics, these are well understood. It's often in the case of energy shocks. And sometimes you will do a tax on extraordinary profits. Right. You do something that's very tied to an event, it's not permanent, so you don't like disincentivize future business investment. I mean, we didn't do that this time, but I think there's an argument for, and a theoretical basis for it. Some of this was profit taking, not shame on them, but like there was just an opportunity. And there are some policy things one could think about in the future to avoid that kind of, I mean, nobody should have profited off of COVID or Putin, right? But that has to be a policy response. You can't just wag a finger at a business. Like, they have profit, or they have shareholders. Now, there is an alternate story, and this is probably more mainstream and one that the Fed thinks about, is, well, we just had a lot of demand. And so if there's a lot of demand and supply is limited, well, prices go up. Right. But I think if you listen to earnings calls, if you get outside of the economist bubble, it's hard to square that entirely, though that is also true. Right. And that's the piece of the rescue plan, other demand things. They did have an effect on inflation. But it's a question as to whether you can the Fed just says, okay, we think about the consumer demand and we can go through that lens. You could alternately go through the producer lens, but it's all the demand. They're like, well, but if it's all the consumers and it's all demand, then we don't need to worry about this profit taking stuff. Like, it's just kind of a side show because it's all related. So I think it's more complicated than that. And that's going to be a tough one to see how it shakes out. That's a pretty heated debate among macroeconomists as to what was really going on with profits. Now, I will say, I'm also kind of like, where are we at right now? Where are we going? As opposed to the debates we're going to have for decades. And it does look like that pricing power is waning and consumers are being more price sensitive. I mean, they're getting a little feisty about these high prices. And that's something that companies are noticing. And you do see a tone shifting in like the earnings calls where they're making clear, these increases in prices aren't going to keep going on forever in such a big way, because they're going to start losing market share. But they got their prices up a lot and a lot of their costs are falling now. So it's not like the shareholders are going to be left holding the bag. Like, they're still in a situation to be profitable, and yet that profit is not going to come as much on the backs of consumers as it had the last few years.
Yeah, no, I hear you there. And then, on the labor market, I mean, you have a rule named after yourself, the Sahm rule, which is fantastic. I mean, first, why didn't you state what the rule is? And, do you still hold to the thresholds that you've talked about with that rule?
So the Sahm rule is a recession indicator. So it doesn't forecast a recession. It's a accurate way to say we are in a recession. So in the early months of a recession, before like the National Bureau of Economic Research would say we're in a recession, that usually comes many months later. I use the labor market as a way to indicate a recession. Specifically, I take the US national unemployment rate, the 3 month moving average. So I go all the way back, creating a series. We would never want to overreact to a single month of data, right? This is true in any case, but especially when you want to have an accurate recession indicator. So we take that 3 month moving average. I look at the most recent value and compare it to the lowest over the prior 12 months. So in the US right now, the latest data we have for January says it's 3.7%, that 3 month average. And the lowest over the prior 12 months was 3.5%. So you got a 2/10 percentage point increase. And what I have found is that historically, a half a percentage point increase, you're in a recession, right? In the early months of a recession. So we are not close to triggering it. The unemployment rate tends to move pretty slowly. So it would be hard, and I would have a heart attack if it went from in January not triggering to in February triggering, right? Like that just you'd have to have a big increase to get it up to an average of 4%. So now I always say this is not to your question about is that trigger the right one? It's the Sahm rule is an empirical regularity. It is not a law of nature. It has been perfectly accurate since the 1970s. It has never triggered outside of a recession, and it has always triggered in a recession. But this time really was different in a lot of ways. So if the Sahm rule were ever going to break, as in it triggers at a half a percentage point, unemployment goes up a little and then it kind of goes sideways, that's not a recession, right? Typically in a recession, even the mildest one, the unemployment rate will rise 2 percentage points. And in severe ones, it's more than that. Or even like kind of typical ones, it's more than that. So if the unemployment rate only goes up to like 4.2 or something and hangs out, that's not a recession. So that would be the Sahm rule breaking, like it triggering outside of a recession. If it were ever going to do it, this would be the time. And it would be in good company. So we had 2 quarters of declines in GDP in it was in 2022, and there was no recession. There were some very specific COVID reasons. Like one quarter, there was this inventory swing, and the other quarter, it was net exports, which also, think about all the problems that were being worked out with trade and goods. And there you go. You got 2 quarters. Labor market was great. That will not be called as a recession. Like there's no way. You have to go back to 1947 to find 2 quarters of a decline in GDP outside of a recession.
Hmm.
Now, 1947 post-war, that probably was a pretty good analogy to what we have. When there was a big disruption, supply disruption. But in any case, like 2 quarters of GDP, it broke. The yield curve has been falling on its face. That's not totally atypical. But the Sahm rule could break too. Right now, it looked in the fall like it was getting kind of close. Now with the revisions and then unemployment rate moved back down, like it doesn't feel that close anymore. But
Yeah.
I mean, I'll take it seriously if it triggers, but I'm not losing sleep over it right now.
Yeah. And as you rightly point out, other indicators such as the yield curve, which is something we've tracked, obviously GDP, they've given you false signals of a recession. So having your rule actually does make a lot of sense. I guess let's come to the Fed now, and this kind of relates to some of the things that you've sort of described. We've had all of these hikes by the Fed, yet we didn't see the recession last year. Many people were anticipating a recession, and it didn't happen. Data so far this year seems to be fairly strong, robust, notwithstanding relatively weak retail sales. But overall, it doesn't feel like, higher rates have had much of an impact. So, how do you interpret this?
We know that the Fed, these interest rates are having an effect. If you look at the interest rate sensitive sectors like housing, to some certain parts of business investment, there was a clear weakening in, I mean, it's the current circumstance a little harder to read, but it was clear as they were doing aggressive rate hikes, this was showing up where you would expect it to show up. Now, the way the Fed works is, I mean, first, it works through financial markets. Financial markets clearly got the message when they're raising rates. So it shows up then in higher interest rates for consumers, for businesses, whether it's mortgages or credit cards or business loans. So those rates went up. And then you did see a pullback in quote unquote activity, like people out looking to buy homes, residential investment, was contracting. Now, for fiscal policy to really slow down demand, it has to work its way into the big part of demand, right? Consumer spending is almost 70% of the US economy. So these interest rate sensitive sectors, investment, they're relatively small. So you have to have this, the dynamic is, you start an interest rate sensitive sector activity, the businesses pull back. So then they don't need as many workers. Well, then those workers don't have the money to spend. And so more workers get laid off. So there is this cycle of, I mean, frankly, it's demand destruction, right? The Fed's tool is interest rates. It is a price that people pay. It's a price they pay to, borrow and, buy large, costly items. And the old, like, when there's inflation, you've got an imbalance of supply and demand. The only thing the Fed can do is bring down demand. It has no tools to bring up supply. And so they were doing their job with the tool that they had. And yet that's the this case of 2023 where real GDP growth, real consumer spending was 3% for the year. I mean, that's above what anybody would think is a trend estimate coming into COVID. And unemployment is below 4% for its longest stretch since the 1960s. And inflation came down. So this is not textbook Fed interest rates in action. Now, there's a lot of different stories about the anchored inflation expectation. I mean, there are ways to like twist and turn this so that it's the Fed. It's not my baseline story, but we're going to be debating this for a while. Now, that doesn't mean this has to go on. Right? There are some very important buffers in the economy. Like we've had a strong labor market, we've had consumer spending, but people have had some money on the side. There were some other fiscal programs that rolled out then later, like the 3 investment packages. So those interest rates are under the hood, right? They're down there. The interest rates are still high. By any measure, they are higher than what would be the Fed is out of the way, not having an effect on decisions, right? Like this is 5.25% is high. So that means that pressure from the Fed is still there. They have signaled that they have no intention of cutting soon. It's going to be several months still. And so then it's a little bit of a game to see, well, how much is left under the hood? And how long can these buffers hold up? Because one of the things that is so hard about forecasting a recession, despite the fact for over 2 years, I had to listen to, a recession is coming, recession. Things can turn pretty quick. I mean, often it's some bad event. We could put a lot of stress on an interest rate sensitive part of financial markets. Like we talk a lot about commercial real estate, but it could also be private credit. This is a fairly non-transparent part of the market. The saying is the Fed goes until it breaks something. It could break something in financial markets. It could put pressure on the labor market, which has been moderating, notwithstanding a big payroll number. And so it's this balance. Like they want to do enough. We need inflation down to 2%, but they got to be careful not to do too much. And
yeah,
the idea that those effects are gone, I think, is a misguided view. They're still under the hood. These interest rates still matter.
Yeah. I was going to just take you up on the point about, these rates are high. One question, I suppose, and this is with an economist hat on, is where is the correct neutral rate? The Fed, and a lot of people think in real terms, it's around 0.5. So current policy rates are very high. But perhaps its neutral rate's gone back to where it was before GFC period. Maybe it's 2% in real terms. So say 4% in nominal terms, assuming 2% inflation, in which case policy isn't super tight. So that's the first question I had. And then kind of a related question then is, if you look at the 1990s, the Fed had that dramatic hiking cycle in 94, and then rates stayed high for a long period up until the dot-com period, so 4 or 5 years. I mean, there was some sort of fine-tuning of policy rates around Asia crisis, LTCM, and so on, but they stayed out high for a long period of time. And, the economy was fine overall.
Yeah. So in general, it's important to have a discussion about the neutral rate, only because that's how we frame that debate. I'm not a huge fan of the stars. So the R star or the Y star, just because it's something we can never know. We can't measure it well, but I think conceptually is a useful way to think, right? And what the neutral rate, I think the most important thing the neutral rate gets across is, by the time that we get to the dual mandate, because the neutral rate ties back to the Fed, right? So where you get to a place where inflation is a target, it's at 2%, and it looks like it's going to hang out there, right? It's not just about touching 2 and then bouncing off. So we're around 2, and unemployment is low. Right? We don't know exactly what that number is, but it's pretty low. Okay, so by the time we get there, the Fed should be out of the way. They should not be having an effect on interest rates, right? The Fed should have no opinion on what is long-term growth, right? Right now, I'll hear people say, oh, well, growth is still high, so the Fed shouldn't cut. This is not the argument the Fed makes. They look at growth being strong and be like, oh, it gives us the luxury of time, right? The economy is strong, so we can wait until we're really sure, because we have this kind of safety net for waiting too long. But the Fed, if we end up with 3% growth or 2% growth like that, once we're back to dual mandate, that's fine, right? And I mean, I want to understand why it is. It is absolutely the case if we come out of this cycle, and it looks like we might, these are early days, but if we would come out of this cycle with higher productivity growth, that would be a reason that the economy can comfortably support higher interest rates than going into this. Now, we still have the demographic issues that we had going in, into COVID, and frankly, into the GFC, and immigration has been buffering a lot of that for the United States. But given the very heated debates over immigration, that offset may not be there. So there are reasons why you could think going forward, we go back to where it was. And I think Olivier Blanchard has outlined some very good reasons why the prior trend is where we ought to think we're headed. And then, if you get the productivity, if the full employment economy keeps firing on all cylinders, there is a dynamic that would say, hey, it's higher. Now, I guess thinking in nominal terms, so we're at 5.25 before. I think it was 2.5 was what the Fed was thinking in the nominal rates. I've heard Fed speakers, this is why I don't particularly care for the nominal or for the neutral rate, is kind of they've been very clear. Oh, at 5.25, we're in restrictive territory, which means we're above neutral. And they've kind of said, and we're well above neutral. They've said this for a while. And I think that's true, because you can definitely see in mortgages. And then there's a lot of discussion about, well, we're probably higher than before. So that means we're somewhere between, the neutral rate is somewhere between 5.25, probably below that sum, and above 2.5. See, to me, that much specificity is basically useless, right? Because that doesn't tell me how. So if I had to, guess, given what we know about productivity, and I do think we could come out of this with higher rates kind of staying there. Well, then maybe it's 3.5, something like that. But inflation is within a percentage point of target, and the Fed is almost certainly going to go in 25 basis point cuts spread out some. It's kind of well, what are you waiting for? Right? We're, recognizing inflation has come down a lot. Now, I know they're not going to do that, and they do have their reasons for it. And I'm not I get it, but there's some of their logic strikes me as risky. And I worry that they won't be out of the way when we get back to the mandate.
Yeah. And so let's talk about the Fed this year then. So there was at one point speculation that they could cut in March. That seems to have gone away now. And now markets seem to be thinking like June perhaps is probably the first sort of proper sort of cut risk in May. What's your view? What do you think? Well, first of all, what do you think they will do, and what do you think they should do?
Right. I never understood the March sentiment. Right. And I had some friends who were very good forecasters who were like, no, they're going to cut in March. And I'm like, I just don't see this. So my take on the Fed this year is the Fed is always little c conservative, right? They're always going to we need to go slowly and we want to be confident and all this stuff. And they feel like they got burned in 2021, right? And I mean, one could debate how burned they actually got or how much COVID coming back again and again caused problems. So they're going to be very conservative. They're going to want to build a lot of confidence. And then I have argued for many months now that whatever you think the Fed is likely to do this year, add a meeting to it. Because they are it's unfortunate, but 2024 is lining up very much like the 1970s did for the Fed. I've said numerous times, no one at the Fed wants to be Arthur Burns. So Arthur Burns was the Fed chair in the 1970s. He did two things that have gone down as absolute no-nos. The first is when unemployment started to rise, and inflation was high. I mean, it was notable. He would cut interest rates as unemployment started to rise to, avoid a recession. And then after that, inflation would come back even higher, right? So there was this period of trading off more and more inflation versus unemployment. And then the thing that he did that was very unfortunate is when Nixon was in his reelection campaign, he leaned on Arthur Burns to cut interest rates to keep the economy good for the election, which he did and was confirmed later in Nixon's tapes. And then after the election, again, inflation took off. So then by the time Paul Volcker came in, they had high inflation, it was embedded, and the Volcker Fed engineered a recession, right? They were trying to break embedded mentality of inflation, and nobody wants to have that happen again. So it turns, so this year we've got they're in this trying to bring inflation down. They really want to get it down. They don't want to get head fake because if they cut too soon, then inflation could come back. So they don't want to do that. And it's also an election year, right? And I don't think the election, I've argued in a Bloomberg piece recently, the Fed gets wrapped up in politics. I mean, the Congress created it. I mean, it does have a relationship, but it's not partisan. Right. I don't think this will affect their decision making. And yet, the legacy of the 1970s. So to me, that's been the whole add an extra meeting because they don't want to make those were considered and were some really bad mistakes in the 70s by the Fed.
I mean, on the election, I mean, could you also argue the other way that they might want to try to front load any cuts to avoid doing anything close to the elections?
No.
Okay.
And because to them, their credibility as inflation fighting institution will push them towards later cuts, right? Because they're just going to want to be so sure that they're confident it's coming down. They want to be confident that the story you told before about the goods inflation goes off and they want to be so sure that's not happening, right? They really want to see that services inflation coming down. And the thing that the Fed, switching a little bit from what they're likely to do, what I think they should do, they have become, and this relates, I think, a little to the election, they have become hyper data driven, right? When Chair Powell was on 60 Minutes, he recognized the fact we've had 6 months of good data. We want more good data. It doesn't have to be as good or better, but we want more. Okay, so that means, and data are by construction, backward looking, right? And so even though monetary policy works with some lag, so it has a forward feature to it, they're looking behind them to make sure that they're really confident. That is not a typical way to do monetary policy. I mean, it's more sophisticated than that, what they're doing. but that's what they're saying. And so markets, every single data release, like the probabilities around when they cut just are like flop all over the place. That is not healthy for markets, right? The Fed interprets data well as a very good example. The week we got the CPI for January was bad. It's just full on not good. There's some special factors, but I mean, setting all that aside, it was still not good. And then people started moving off of May into June, right? Because bad. Okay, then retail sales comes in on the Thursday of that week, and it looks bad. So then it's like, oh, maybe they actually will cut sooner because it looks like a recession. And the Fed has been clear now. We've got both sides of the mandate. Like we're really watching both sides because again, they're within a percentage point of target, right? So they can't just totally say it's all inflation. Okay, so retail sales is bad. So you're like shifting back towards May. And then PPI, the producer price was bad. And so like they go back to June. I was watching Mary Daly spoke at a conference I was at that Friday after we've had all three of these data points. And she said, nothing this week has changed my views about inflation. So you've got the markets all over the place, and a Fed person, it's kind of like this is what happens. You have bad months, you have good months, right? And so, but markets don't. Everybody wants to know, like, when are they going to cut?
Yeah,
How much are they
yeah.
going to
I mean, at
cut?
the same time, I mean, they are, as you say, they are data dependent as well. So to some extent, they are leading the
Yeah,
market down this route. Where they're really sort of trying to move away from saying we have a model for the world and
yeah.
this, that, and
But
the other.
it's a problem
Yeah,
because I mean, first of all, they're so hyper data driven. That means every data release is like hyper reaction, and also monetary policy works forward, right? So there's a little bit of a disconnect, but the connection I would make to the election is they're going to drag their feet and they're only going to cut when it is so painfully obvious that inflation is like really headed to two. And because then they can say, hey, look at the data. This wasn't us Fed trying to put a thumb on the scale for anybody, or we're not being like behind the. Yeah, I mean, like for them, it's going to be like, here's the evidence. Look at the data we're looking at. And it does give them some, they're pulling some of their discretion out. I mean, they're
yeah.
setting the bar and they're going to make a decision. It's going to be a really tough decision. And yet that, yeah,
I mean,
it's
on
kind
on
of
the
an
election, the
interesting.
thumb on the scale is an interesting point because this election is somewhat different in the sense that Trump, you have the Trump factor, which is a very unusual
Mhm,
character who, at its heart, is kind of like a wrecking ball to the establishment, which includes the Fed
mhm.
as well, very disruptive to institutions and so on. So there could be an argument to say that the Fed actually generally don't want him to be in power, and so they'll do whatever it takes to help Biden, retain power, which in this case maybe actually cut rates, juice up the economy, allow stocks to do well. So perhaps they don't care as much about inflation; they care more about ensuring institutional continuity going forward, which means that is more important than inflation credibility.
They they're they're not going to put a thumb on the scale.
Mm.
I mean, again, if you go back to the 70s, Arthur Burns and Nixon, that is considered one of the really dark spots
Mm.
on Fed history. That is so outside of their job description. I mean, what is ethical? I mean, the Fed is an institution that does not report directly to the American people. I mean, the Senate is the president nominates members of the board of governors. The Senate has to confirm them. So they are tied into a process where people are accountable to the electorate. But if they would just kind of go rogue and try to get Biden elected, I mean, first of all, it could totally blow up in their face, and then they get in big trouble if Trump gets in. It's just not. It's not their. It's just not in the fiber of the institution. And the times where it has come up are really considered like we are never doing that again. I mean,
Mm.
it's not the only mistake the Fed has made over its history, but so I don't see any upside from them. Now, I do think that they would really like to have a Fed at the other side of this. So, for good reasons. So that making sure the institution comes across as credible and thoughtful. And that Jay Powell's 60 Minutes interview came across very much that way. And he was speaking to the American people, right? And trying to convey, or at least what I saw him convey, was I am a sober-minded, responsible individual. He even wandered into some what I think would be considered more political discussions about, the federal debt is unsustainable and immigration was good and geopolitics. We have to. So he kind of got in some spaces, but it also made him sound like I'm awake. I know there are these issues. I'm going to talk. Look, I can even talk in a bipartisan way. Because I mean, there was something for everybody in the like outside of Fed policies that you talked about. That trust in the institution is what will keep the institution whole on the other side of it. And getting involved in election politics would not give them trust. And yet the Fed always gets blamed. This is just a rule of the Fed because they can't fight back. So, like, Congress will blame them, other people will blame them, and it will be impossible to prove that they didn't have a thumb on the scale, right? Because if they wait to cut and we go into recession, then it looks like they were anti-Biden. If they cut, like say they end up cutting in September, right, or something, or October, right, before the meeting, well, then they're helping Biden. So they're going to do what they feel is best to do, and try in the messaging and the optics to protect the institution, but not try to protect the institution with the rate decisions. But
Yeah.
I won't be able to prove that.
Yeah, no, it's a
They
fair
won't
point.
either,
They'll be blamed no matter what.
Yeah.
Even outside of election cycles, they get blamed for everything. Whether the economy does well, badly, everything they get blamed for. Now, on the Fed, we didn't come up with your forecast for this year exactly. So when do you think they'll start to cut by how much eventually? What will be the cumulative amount of easing that you think they'll end up doing?
I am somewhere between May and June in terms of the first cut. That January data was unsettling. And it could be, and talking to some other people who do forecast, it could be that the spring is not particularly good. Like the disinflation really slows.
Okay.
Right. I do not expect an acceleration. Like that's a risk I put pretty low weight on. And if things kind of bump along January, February, March, we're talking about June. Right. Like, but I think there will be a cut some June or May. Like, I don't think they're going to keep pushing this unless things really go off the rails. And then I think it's a cadence of, 25 basis points every other meeting, unless something starts to go south in the economy. Like I do finally, after having listened to them, several of them say this, I am starting to take them on their word that if the labor market falters, if consumers falter, they will step in. And the sooner they do that, the more gradual they can be. The Fed really likes to be gradual. And they and I think all of us should want them to end up with a Fed funds rate that is higher than it was going into this. Getting away from the zero lower bound, while not the most important thing about this recovery, would really improve monetary policy going forward. The unconventional tools, the asset purchases, this has been they're probably the least of all bad tools that the Fed has when it gets to the zero lower bound, but it would be really nice not to have to use them ever.
Yeah.
Again.
And then on terms of data that you're watching to sort of see signs of weakness in the labor market or the consumer side, what are the indicators you kind of put a lot of value on?
So I look for signs of weakness. I look at the labor market and getting under the hood. Right. So the payroll, I mean, you want to see good payroll numbers. If you start seeing negative payroll numbers, there's likely something is going on. It can be noisy, but like if that's really turning on, then you want to spot labor market weakness before it turns into a free fall. Or, if that dynamic gets going too far, then it's really hard to stop. And then the Fed doesn't get to do 25 basis points. It has to do 100. Right. And then you start getting back down. But what I've looked at, I think a couple of places that have been flagged with some concern is if you look in the job openings labor turnover survey, so the JOLTS, we've seen the hiring rate, which had been really elevated because of labor shortages. And obviously, we're going to stay at that. It's been moving down, which one would expect. And instead of kind of flattening out where it was before COVID, it's actually started to drift down below. Right. So that if we're not hiring people, this is a problem and could lead to rising unemployment. And it could also be a sign there's just not as much demand for workers. Now, what has held up, so you're always looking for like what's a kind of what looks troublesome or problematic. You want to also make sure you look at like what the if there's a balance out to it. The firing rate has not gone below pre-pandemic. So companies, there's a little bit of this labor hoarding story. I mean, they really struggled to hire people back. So it looks like they're a little less, they're being more conservative about um, firing them. So that's good. But that is one sign. There's also the hours worked are kind of trending down. So what you're looking for is there like less demand for workers out there? Or would there be less in their paychecks? Right? Like if you're working less, even if you're getting paid more, it could offset. So those are two examples. Oh, and the other thing to look at in data in general, this would be true for retail, I mean, frankly, for any kind of data, is often they'll disaggregate it in some way, right? So in the payroll surveys in particular, they have different industries. So one thing you want to look at is, well, is it widespread? Like, are you seeing job gains across different industries? In the towards the end of last year, in the fall, the job gains were very concentrated in healthcare and state and local government. So then that could be worrisome, right? If all the numbers are being driven by a couple of sectors and everything else is looking weak, that's something to watch. Now, in some of the later data we got, it spread back out again. Then it's the same thing we look at retail sales. Is it broad-based, the weakness, or is it a couple sectors? So you don't have to go like super deep under the hood, but spending a little bit of time looking at the data and seeing how solid it looks.
Yeah. And then do you have a view on recession then? Or not?
So throughout this entire cycle, I have had no recession and inflation will come down as my call, right? Like it was a very lonely one to have in 2022. And I'm still there. Like, I think we are on, like, we can see the runway, right? We're getting inflation down to 2%. We are going to avoid a recession. Unemployment stays low. So that's how I define a soft landing. There is a margin for error in the Fed waiting too long, which I think they almost certainly will. And those are things like the labor market is strong. So again, that's what I'm watching because that's the biggest buffer. So if that one goes, we're in trouble. The consumer is strong, notwithstanding the latest retail sales. There's still money in the bank, right? People have more of a buffer. I mean, the death of excess savings has been, promoted for 3 years straight. People actually do want to have money in the bank, right? So you have that buffer. And I do think some of this, the unwinding with the corporate profits and that pricing sensitivity, to me, that's one reason the last mile of inflation probably won't be the hardest. So I think you've got, and the Fed, if we get faster to 2%, the Fed will back off, right? Like they are watching the world. So I think there are a lot of things in place for us to avoid a recession. And frankly, I feel better about it than I did in 2022 or the first half of 2023. Because like I had a story, I think I had logic on my side with COVID, but I did not have data on my side, right? Like because inflation was going up. And if it really were demand driven and embedding, then yeah, it was going to take a lot of demand destruction and a recession.
Yeah,
does not look like the case.
No, you've made a good call certainly over the last few years around this all. No, we could carry on talking about the Fed and inflation, but let's put a hold on that now. I did want to ask you some of your thoughts on the economics profession. You've been on the academic side, you've worked at the Fed and so on. I mean, what are your thoughts on economics as a profession, at least in the way you've seen and experienced it?
We can do better. I think that's true of any profession. There one aspect that is in the work I do right now, thinking about the policy discussions, is we macroeconomists tend to struggle, I think, for a lot of different reasons in bringing in alternate perspectives. And I like people in general. I like to learn from people who aren't me. And that often means finding individuals who have backgrounds outside of academic macro or policy macro. And in particular, outside of what one would call mainstream, right? And I've learned a lot from, say, Isabella Weber and Stephanie Kelton, who are not considered mainstream economists and kind of quote unquote heterodox economists. I might not agree with all of their positions, and yet listening to them and exchanging ideas, that's been really helpful in my thinking. I've also found it really helpful to talk to people who are in business or who work in markets, or I listen to podcasts. Yeah, I mean, like, to me, that is it's so important to bring in those other perspectives, which help me test my story in a way that just talking to other people who are trained like me is not going to cut it. So there is a broader picture, if you go back to the profession, is you shouldn't have to go outside of the profession to find alternate views, right? So if we're really lacking perspectives inside the profession, that is a sign that we have a problem. I firmly agree with Janet Yellen when she says to do a good economic policy, you have got to bring a lot of perspectives. The economics profession has a long history of excluding a lot of groups from the profession. And that can be, individuals who come from marginalized groups. The representation of people of color, is just abysmal in economics. Women are underrepresented. Another big group that is terribly underrepresented are people that come first generation college students from working class backgrounds. It's actually a astonishingly high fraction of economics PhDs who have PhDs as parents, right? And that's totally fine, except when that's your main group, that's not the typical experience of the individuals who you're helping design policy for. So bringing those individuals in, giving them space, right? Like, I work a lot with students and mentoring, and also like kind of yelling up the food chain about we need to do better about this. And it's not because I want to bring in someone who's just like me. Like, one of me is more than enough in the world. I want to create space so those people that come in can feel like they can develop their ideas, not that they have to replicate what's the standard in the field. And we have to do a better job, not just bringing in the pipeline, but also reaching out to the scholars and the people who are out there doing work. It really upsets me when I see individuals working in a heterodox background just full on attacked by people that have more mainstream training. It's like, what are we doing here? Right? We should be trying to sort out views and learn something, not be threatened by the other. So I think it's just a broad difficulty that economics has. And for me, the first step is to create the environment that's supportive, to create a healthy, inclusive environment. And we actually need to do that even before we work on the diversity. Because I am adamant that if we bring in a pipeline, if we're like, oh, diversity, diversity, and we bring them into an environment that is hostile, like, diversity without inclusion is cruel. And I have seen that. Like, the easy thing is just to bring them in. The hard thing is to help them and support them. And yet, if you don't do that, like, they're going to leave anyways, or you're going to break them. I mean, like, and so that's not, but economics is trying. And I think there's more and more an appreciation for this value system that I've talked about. It's hard work. And frankly, economics has a large contingent of fairly senior people who think this is all a joke. That, I've had a friend is like, well, if there's not women in economics, that's because they don't want to be in economics. It's an equilibrium. Da, da, da. And I'm like, have you ever thought about why they don't want to be in economics? It's like, so you get it's a little
Yeah.
tough. I mean, we still have a long way to go, but we'll get there.
Yeah. And then your experience of writing a newsletter, I mean, is that, have you found that to be quite rewarding?
Yes, I've had so I have a Substack now, the Stay at Home Macro Psalm, to play on my last name. That has been very helpful in trying to bring the economic debate to a more general audience. Right? I'm writing there not for my peers. I am writing for students and people who are interested but don't have a technical background, or policymakers or their staff. That so I'm taking the economics debates, trying to make them accessible, trying to make them a little fun, probably sometimes a little too much fun, and create that, do the translation. Like, I love the Fed. I could think about the Fed all day, all night. Like, it just fascinates me. I love the people there. It doesn't always love me back, but I want people to understand the Fed. Like, it is a very not understood institution, and you cannot hold someone accountable if you do not understand what they are doing and you do not understand their job. So it's like, I want to pull back the curtain on the Wizard of Oz and help people understand the Fed. And the Substack has given me an opportunity to do that, because, and I feel that is a niche that is not filled, right? And I write some in the paid part of the Substack on like people who are really like Fed watchers, and what, I like wonk out on the neutral rate and all that stuff. But the public's writing, which is predominantly what I do, is trying to pull back the curtain. And like I said, I find it a lot of fun. I also write on fiscal policy, macro developments. So that's been a good outlet for me. That's very economics focused. I had a blog, a macro mom blog. I mean, it still exists, but I don't write on it. That was writing about diversity and inclusion. So that one was a broader thing, but I separated out the two. So it's the macro on the Substack. So.
Okay, great. I'll include a link on the show notes to that as well.
Mm-hmm.
Now, I want to round off with a couple of more sort of personal type questions. One is, what advice would you give to youngsters leaving college?
Oh, goodness. Well, there's this whole thing about, follow your passion and all that stuff. But you do need to like go to jobs that you find at least somewhat interesting. Early in the career, it's really important to build your skills. So find jobs where you are going to be pushed to learn something you don't know entirely. Like, you got to get your foot in the door. So you have to know something, really work hard to get the skills. It is extremely important. Like, your boss matters. So make sure, as the best you can, try to understand the culture of the company, who you'll be working with. And even if the boss doesn't end up being that, mentors are important. Like, and they don't have to be like a year-long commitment. It's having coffee. Like, you early in your career, you need to build your skills and build your network, because they're going to be very helpful going forward. Another thing that might not be as intuitive, early in your career is a time where you're going to figure out what you like and what you don't like. Sometimes you will end up in a job where you really don't like it. It is much better to figure out what you don't like earlier in your career than when you're 40, right? So sometimes it's just like, we often learn the most from our mistakes, right? So sometimes you can learn a lot from a bad situation. Don't suffer, right? Go find the thing you do like. But if you end up in that, it's an opportunity to learn what to stay away from in the future. So I think there's a lot of exploration, building skills, building network, learning about yourself.
Yeah, no, that's great. And then on books, are there some books that really influence you over your career? It could actually be unrelated to your career as well.
Yeah, it's tough. I have a whole bookshelf on the Federal Reserve. There's one line. So no, I enjoy reading economic history. That's one thing that I think is maybe a little atypical, and that comes from my background. Like, as an undergrad, I did a lot of history of economic thought, and I just find it, to understand and to understand the Fed. Like, you really need to understand what's happened in the Fed over time. And it's kind of interesting. And there's different books, and uh, Greenspan's memoir was a little bit of a tough read, but It's like you can find something for everyone. And one book that was really influential during this crisis, um, I read a biography of Frances Perkins. So she was one of the architects of the New Deal and promoted workers' rights and the Social Security Act. Just, I mean, really, a lot of the things that we think of as part of our social safety net today, she was active in uh, pursuing. And it talked a lot about her, not just her policies and where they came from, but also some of her personal struggles. I mean, she was a woman in the 40s trying to push through major legislation and like various family issues. And but it was like at the same time, like I was working on these fiscal policies. And this was a pretty rough road, especially being a proponent of the rescue plan was not easy, right? This was a very contentious debate among my peers, even kind of left of center peers. It was a pretty bad debate. So just reading her history and being impressed by what she'd accomplished, and yet knowing, people that accomplish a lot, they face a lot of challenges too. Like nobody just sails through this. So I find reading biographies, like, and not just economists or policy people, that often I find very, very helpful.
Yeah, that's fantastic. And then just last question, what's the best way for people to follow you? You've mentioned the Substack. Are there other places they can follow you?
Yeah, so the Substack is probably the best place. I mean, I write about weekly-ish, and there's lots of different topics, and you can find there's a large archive now. I am also on Twitter, though I'm trying my best to wean myself off, and that's at Claudia_Sahm. In general, for people interested, I mean, there's a pretty good economics debate and then FinTwit for a lot of the more Fed related. So that's why I can't quite get off it because there's just too much interesting stuff on there. But yeah, those are the two main ways to find me.
That's fantastic. Okay, with that, that's been fantastic. I really enjoyed this conversation and keep up the good work.
Great. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.